Welcome in, everyone. I'm Grant Mercer. This is Storm Stock Solutions, and we're getting you set up for the trading day ahead. Let's bring a little clarity to the chaos as we head into the last full week of trading for the year. According to reporting from MarketWatch, U.S. stock futures are pointing higher this morning after a rough Friday that saw a sharp decline in the tech sector. The key storyline is that rotation out of the crowded AI trade. Some of those high flyers finally took a breather, and now futures are hinting at a bit of stabilization, maybe even a relief bounce, as we come into Monday. Stepping back to the macro backdrop, there are two big forces traders are watching. First, politics and the Federal Reserve. MarketWatch highlights comments from Kevin Hassett, a top economic advisor to former President Trump, who's being discussed as a potential Fed chair candidate. He's out saying that Trump would have no weight on Fed decision-making if he got the job. Now, whatever you think of the personalities, the market hears one thing: possible changes at the Fed. Any hint that policy might become less independent, or even just more politicized, can inject uncertainty into rate expectations, and that tends to show up in financials, rate-sensitive growth, and the dollar. Second, this week is the final stretch of the year, and that brings its own kind of volatility. Isabel Wang at MarketWatch notes that a delayed November jobs report and a key inflation reading are still on deck, and they're not the only potential catalysts. In the last push of the year, you often see portfolio rebalancing, tax loss selling, and window dressing by funds. That can exaggerate moves in both directions, especially in names that have been big winners or big losers in 2025. On the opportunities and strength side, we don't have a clear sector scoreboard yet this morning, but there is a theme. One of the more widely read pieces this morning, oddly enough, is a personal finance story about children paying rent on their parents' investment properties and whether they should still buy them out. It might sound far from the trading floor, but it speaks to a broader narrative. Real estate and personal balance sheets remain front of mind. When investors think about where they're positioned into year-end, property exposure, whether through REITs, home builders, or rental markets, tends to come back into the conversation. Professionals will be watching whether Friday's tech sell-off continues to push money toward more tangible, cash flow-heavy assets, like real estate-related plays and dividend names. On the flip side, areas tied directly to Fed credibility and interest rate expectations are ones to handle with care here. Those Hassett comments about the Fed chair role may keep a spotlight on the central bank's independence. If markets start to doubt the Fed's ability to stay focused on inflation and employment data rather than politics, you could see some choppiness in banks, long-duration growth stocks, and anything that's highly sensitive to where the 10-year yield trades. That doesn't mean those groups fall apart. It means the headline risk is elevated, and intraday swings can be sharper than usual. Let's talk about a few sleepers and under-the-radar stories I'm watching in the background. First, Irobot. MarketWatch reports that the Roomba maker has filed for Chapter 11 bankruptcy and will be going private via a pair of Chinese companies. The stock itself has been pummeled for years, so this isn't coming out of nowhere, but it's a reminder that not every early mover in consumer robotics or smart home tech gets a happy ending. Traders may look across that broader consumer tech hardware space and ask, who has real, durable cash flows and who's still living on narrative? Second, healthcare and the Affordable Care Act. There's a key deadline today for enrolling in Obamacare if you want coverage to start January 1st, and as Jamie Lee notes, the subsidies that made plans cheaper are set to expire, meaning 2026 coverage could be much more expensive. That doesn't move the tape on its own this morning, but in the background it's part of a bigger story for health insurers, hospital chains, and managed care names. If households face higher out-of-pocket costs down the road, investors will be watching how that filters through enrollment, margins, and policy debates. Finally, the series of personal finance columns about retirement planning, Social Security choices, and financial advisor due diligence are also trending. Again, they're not direct trading catalysts at 9:30 a.m., but collectively they show a retail investor base that's thinking hard about risk, longevity, and who to trust. When those themes bubble up, you can sometimes see more interest in low-cost ETFs, income strategies, and large familiar blue chips versus more speculative ideas. So, putting it all together for today's open, futures are trying to bounce after a tech-led slide. Rotation out of AI and megacap growth is still the core story, and the market's eye is on upcoming jobs and inflation data along with the political denial. Noise around the Fed. Traders will be watching whether that early bid in futures holds once the cash market opens, whether money continues to move from high multiple tech into real assets and defensives, and how sensitive rates are to every new headline. I'll be back with intraday updates once the market gets going to track how this rotation is actually playing out on the screen. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.